are non-taxable and when they're taxable. So first off, a student must be a degree candidate at a primary, secondary, or accredited post-secondary institution in order to be tax-free. That means the institution must have a regular faculty, curriculum, and enrolled student base at the place where it carries on educational activities. This also means that scholarships awarded to students who are not in a degree program those are always going to be taxable. So maybe some online degrees may not be qualified. In addition, in order to be tax-free, the scholarship must be used for qualified expenses. This is specifically tuition and fees and expenses, but only expenses that are required for all of the students enrolled in a course. So books, supplies, equipment, if your school requires you to have a laptop, or maybe lab fees for a science course. Non-qualifying expenses for... Hello? Non-qualifying expenses for scholarships include room and board, research, travel, clerical help, and equipment or other expenses that are not required for enrollment in coursework. So obviously, room and board are probably going to be the biggest expenses that are not going to qualify for tax exemption. There are other types of tax-free scholarships, but these are also subject to the same limitations on scholarship use. The money must be used on qualifying educational expenses in order to be tax-free. So veteran benefits, athletic scholarships, and need-based education grants. But for the veteran benefits, this is important. The IRS does not consider funds that veterans receive for education or training to be taxable, but for their offspring, their families, those benefits can be taxable in the same way that ordinary scholarships are. Now, the Tax Cuts and Jobs Act affected the taxability of scholarships. It has not changed whether a scholarship award is taxable, so those rules are the same, but it has changed how the tax is calculated and may result in a tax increase for scholarship recipients. The key to determining how a scholarship is taxed is the difference between earned income and unearned income. Earned income refers to if a scholarship is tied to income that is earned by the student, it is taxed at a student's tax rate, which would presumably be quite low. In addition, the new tax law increased the standard deduction to $12,000. So although wages are subject to withholding for Social Security taxes at 6.2% and Medicare taxes at 1.45%, anyone can earn wages of up to $12,000 without paying federal income tax. So if a scholarship award is tied to, say, working in the cafeteria, you would be limited to the student's tax rate. There are also opportunities to offset earned income with education tax credits. So the American Opportunity Tax Credit, the AOTC, allows an annual maximum credit of $2,500 per student for 4 years of undergraduate education. That means if a family has multiple students in college at the same time, you would be able to take this credit for each student. However, in order to qualify, a taxpayer's modified adjusted gross income has to be less than $80,000. There's also a lifetime learning credit. This credit allows a maximum of $2,000 per year per tax return, so it's not per student. And it can be used for undergraduate, graduate, or professional degree courses for as many years as needed. The income limit, however, is lower than for the American Opportunity Tax Credit. Modified adjusted gross income must be less than $55,000 for the lifetime learning credit. Earned income can also be offset by tax deductions. There's a tuition and fees deduction, which allows a taxpayer to deduct qualified higher education expenses of up to $4,000 paid during the year for oneself, one spouse, or one's dependent, the income limitation is the same for the American Opportunities Tax Credit. And there's a student loan interest deduction, which allows a deduction of up to $2,500, but is only available for modified adjusted gross income of less than $65,000. And that all applies to earned income. So a student's summer jobs, any scholarship tied to work while in school. Unearned income is where you're going to see the big changes from the Tax Cuts and Jobs Act. Unearned income is treated differently and may result in higher taxes for students who are recipients of scholarships, and this is due to a modification of something called the kiddie tax. The kiddie tax was originally enacted as a result of the Tax Reform Act of 1986. It was originally established to prevent wealthy parents from shifting income-producing securities to their children who are likely to be in lower or zero tax brackets. If these children had, quote, unearned income prior to the Tax Cuts and Jobs Act, they were taxed at their parents' top marginal rate if that rate was higher than the child's. Unearned income is defined as interest, dividends, capital gains, including mutual funds, gains distributions, rents, and royalties. But it also includes Social Security benefits, pension and annuity income, and taxable scholarship and fellowship grants that are not reported on Form W-2. Excuse me. Sorry about that. Beginning in 2018, however, children's excess unearned income will no longer be taxed at the parent's marginal rate. Instead, incremental amounts over $2,550 will now be subject to the same tax brackets and rates as estates and trusts. The bad news about this is that the new tax law treatment could mean higher taxes because the trust and estate tax brackets are much more compressed than rates for married individuals. Trusts reach the highest tax bracket of 37% when income exceeds just $12,500. By contrast, under the new tax laws, a married couple would pay less than 37% tax as long as their income falls below $600,000. So there's a big difference between how a low-income family with a scholarship exceeding $12,500 is now treated taxed the same as a family making over $600,000. So the best way to try to offset this punitive tax would be for students receiving scholarship awards with both a work-based component and a non-work-based component. They should apply the non-work-based scholarship first to their qualified expenses, which is tuition and fees, which are tax-free. And after the qualified expenses are taken care of, work-based scholarship should be reserved for non-qualified expenses like room and board. Again, if those expenses are lower than the standard deduction, the student may escape tax on scholarship awards altogether. But even if non-qualified expenses exceed the standard deduction, the student will most likely be better off paying taxes at his or her own rate than the kiddie tax rate. There are also some potential legislative fixes. The drafters of the Tax Cuts and Jobs Act have insisted that this treatment of students who receive scholarship awards is unintentional. So Ted Mitchell, who is the president of the American Council on Education, which is a Washington trade group representing 1,700 college and university presidents, wrote to Democratic and Republican leaders of the House Ways and Means Committee and the Senate Finance Committee, urging them to correct what legislators who wrote the Tax Cuts and Jobs Act referred to as a drafting error, meant to simplify the tax code. The drafting error is also impacting Native American children and young adults and families of service members who died in combat, some of whom saw hefty bills for their children's survivor benefits this spring. Accordingly, there is a bipartisan effort led by Representative Elaine Luria, a Democrat from Virginia and a Navy veteran, which would fix the tax law to classify survivor benefits as earned income as opposed to unearned income. But the legislative effects for other scholarship recipients is much less certain. The original House draft on the Tax Cuts and Jobs Act included a change to the kiddie tax rates for unearned income, and the House Ways and Means Committee report for the bill said that the bill simplifies the kiddie tax, quote, by effectively applying the rates applicable to trusts. So it is unclear whether this change was an unintended consequence. If the application of the kiddie tax to scholarships recipients was unintended, one can expect a bipartisan technical corrections bill to be drafted rather quickly. Another potential welcome change may arrive for reverse scholarships. A reverse scholarship flips the traditional scholarship model on its head, and instead of giving money to students as they head off to college, a reverse scholarship provides an incentive for students to return home after graduation by helping them pay off their student loans. Senate Bill 676 has been introduced in the Senate and would exclude certain post-graduation scholarship grants from gross income in the same manner as qualified scholarships in order to promote economic growth. For other types of alternative scholarship arrangements, the effect may be less certain unless you can align those the scholarship awards with qualified expenditures. You're going to have the same tax problems, including that you'd be taxed at the trust and estate tax rates. So it's very important to try to maximize the number of expenditures that are qualified expenses. Does anybody have any questions?
Kristi, this is Bill. I've got one. Is it feasible for a scholarship granting organization to recommend to the student who receives it that they go back to the financial aid office and ask them to readdress what's considered a qualified expense? And for example, one of the examples you used was a computer, a laptop computer. Some programs absolutely explicitly require them. In other cases, you're probably not going to be successful without it, but it may or may not be on the list of qualified expenses. Is it practical to have students ask it to be readdressed, and do you know whether or not financial aid offices ever make any of those changes? The best thing would be for, the laptop, for example, it is only going to be tax exempt if every student attending the university or taking a certain course is required to purchase a laptop or have one. Otherwise, it is not going to be tax exempt. So the best thing to do would be for, to address the university and say, hey, if everyone is going to need a laptop in order to be successful, if you make it a required expense, we can treat it differently for tax purposes. I think colleges are starting to become aware of this issue and how it's impacting their students, and so maybe they'd be amenable to such changes. I'll jump in with another question if we don't have any others right now. Sure. Some of our members are implementing programs that are essentially completion grant programs, that is emergency funds paid on behalf of the student, not paid to the student. And I wonder if you could address the tax implications of that. An example may be that the student has applied to get a car repair, and so the actual car repair is being paid for by the student, not money to the student.
No, from what I understand, completion grants are Basically to prevent students from dropping out because of an unexpected expense that they can't cover. I'm based here in Atlanta, and Georgia State University is one of the biggest universities that's implemented such a program here to help out with students. They just noticed that a lot of students were leaving school very close to achieving a degree, but they just couldn't meet certain expenses. And so a completion grant is designed to help a student with such an unexpected expense. The problem with such an award would be that it would almost certainly be considered a non-qualified expense. So, if you're talking about a car repair, that you're not going to be, that's going to be considered a non-qualified expense.
Hi, this is Stephanie, and I'm sorry I'm coming in a little bit late, so I might have missed this, but I also just touching on what Bill had mentioned. We here at the Miami Foundation pay the colleges directly. We do co-sign the checks with the student, but we do have it for the university so that no funny business happens on the other side. But this would still be considered qualified and not taxable to the student or the family. Is that correct?
Well, the qualified expenses are basically your tuition, your required fees, and any expenses that are required for everybody enrolling in the college or enrolling in a specific class. So maybe if you're taking a science class, like your lab fees are going to be required in order to take that class, in which case that would be a qualified expense. Anything that doesn't fall into those categories is going to be considered a non-qualified expense and is going to be taxable.
This is Sandy.
So then, oh, I'm sorry. Go ahead, Sandy.
You finish if you had a follow-up question to that.
I was just curious, who is the onus on to find out about whether the university did something that was qualified or unqualified with the money that we already provided?
I think, your students are going to file their tax return, unless somebody comes and challenges the way that your expenses are allocated, I think they're going to take your tax return as filed. But if you're given a scholarship award and you're not reporting that on your tax returns the way you should, it probably will send a red flag to the IRS. But in terms of how the expenses are broken out, unless you're audited, it's pretty much going to be what you report on your tax return.
So mine's kind of a follow-up to that in that, we try to always pay our scholarships first before anything else goes up against their account. But many times with Bright Futures and Florida Prepaid and those types of things, they're going to exceed the amount of the tuition and fees. So that piece of it is tax. They're exceeding the $12,000, right?
So, but if there is, if any scholarship awards have some kind of work-based component, you can avoid the kiddie tax by calling it earned income as opposed to unearned income. It's when it's unearned income that you start running into problems. That's when it's taxed differently. But yes, you're correct in that everything that is not tuition and required fees and expenses is going to be taxable in some way. But as I said earlier, the good news about the Tax Cuts and Jobs Act is that the standard deduction has now been increased to $12,000. So depending on the expenses that you're running up, you may still not have taxes, but that's if you've got a work-based component.
We don't have a work-based component.
Okay. I know it's not good news, and I think a lot of people were very surprised when they were filing their first tax return under the Tax Cuts and Jobs Act, and they're being taxed like a trust fund baby, even though they might be a low income student who's can't stay in college without a scholarship.
Well, I think too, one of the challenges in Florida is that with Bright Futures, it's really not income based. And so all of our scholarships are income based. They're different depending on what the intent of the fund holder or person who left the endowment is. And so you may not have a low income on all of them. And that's where I think it crosses into that tax threshold. Like for me personally, we had Florida prepaid. My son's got the max on Bright Futures. And so even with just those two, he's getting money back that's taxable on our income, regardless of the increase in the deduction is actually.
But the unearned income component, your family's income is not taken into account. It's just the amount of the award. And it starts, unfortunately, as low as $2,550, and anything over $12,500, regardless of what your income level is, you're taxed at 37%.
Kristi, this is Bill. We in Sandy, we had a similar situation with one of our sons who stayed in state. And that goes back to my question. We made sure the financial aid office, but Daniel Barkowitz is part of our innovative scholarship work group, and he's a financial aid officer, and he's got the proper terminology. And that is, they consider it an over award if there are more scholarship funds available than the necessary qualified expenses for a student. So we had the financial aid office readdressed, because we think classically of tuition, books, registration fees, but living expenses, if they're out of the area, were also applicable as qualified expenses. And when those were added in, we ended up not having an over award, but actually a small under award. But that eliminated the tax implications, is my point. But we did have to go back to them and make sure that they were recognizing the necessity of living expenses.
So in that case, were they requiring students to live on campus?
He was not on campus, and they did not require him to be on campus. Living expenses, if they were out of the area, could be off campus.
So you're saying that living expenses actually could be covered?
Yes. Now, and so I'm in Tampa. He went to University of Florida. That that's obviously far enough away you can't commute.
Mm-hmm. Okay, because it asks the question about dormitories on your taxes or other living. So I'm not sure how you are able to file that, but that's interesting. Love to hear more. I think part of our issue was he had a job too. So between the job and the scholarships, he became quite.
But that's actually kind of what I'm saying, is that can actually be a good thing if you can break out. If he has taxable income, there's an opportunity, because you can take the tax credits I was talking about, perhaps, or there are ways to offset it if you have taxable income. But if it's just a scholarship award that is in excess of qualified expenses, is considered unearned income, and they treat it like a trust or estate. Mm-hmm. And those have very compressed tax rates, and so it can add up to a pretty hefty tax bill very quickly.
We're coming up on our 30 minutes. Any other questions for Kristi?
Hi, this is Stephanie. I have one more question, and I'm not sure if this is really applicable, but with scholarship displacement happening, where some institutions are taking some of the aid from other scholarships, would you still have to report everything on that return, even if not all of the scholarship award was given to the student?
The student's going to be responsible for the scholarship that they received. I'm not sure I'm understanding your question.
So we've had some students where they've gotten a certain amount of aid from the school, and then we've given them an award, and the institution will take that award for themselves and reduce their own aid that they're giving the student. Like a supplement, to supplement their own award.
I'm not sure about that one. Bill, do you have any insight on this?
Yes, and it's not the tax implications there. We're talking about over award or scholarship displacement, which we had Daniel address in one of our earlier Asking Experts. I'm looking right now to see if I can point you to the recording of that. It's tell you what, email us and we can send you the link, because I'm not finding it right now here. But Daniel's addressed that in some of the trainings that he's provided, and it's a long explanation.
Okay, I figured I'll send you.
20, he would spend 20 minutes giving you the accurate feedback on that.
Okay, sounds good.
Yeah.
Any other questions?
I think we're done. Kristi, thanks again for stepping in and covering the topic so well.
Thanks for having me.
Thanks to everyone else who spent your 30 minutes of your afternoon to learn a little bit more about the tax implications for students. And be looking for the next Ask an Expert with Paul Perrault, which is scheduled actually for next Tuesday.
Thank you so much.
Thanks again. Have a good afternoon.
You too.